In this video, we're going to talk about Evgo, trading under the ticker symbol EVGO. EVGO is a startup operating in the energy storage and charging segment, with its EVGO network and charging stations for the electric vehicles. It is a company with strong fundamentals and good earning results, encouraging market participants to increase their exposure in the company. And it's a peripheral company to the electric vehicle sector at large that is very popular with the market at the moment. Regardless of which manufacturer the market is eventually going to favor over the others, they all need charging stations. And this is where a company like EVGO will rise and shine, because they can benefit from the increase of the overall demand of EVs over the next few decades, which is set to increase its volume significantly over time. As the delivery and storage systems improve in their efficiencies over time, there's a fair chance that the stock will become more valuable. The trading volume of EVGO has recently been 4.4 million shares, compared to an average volume of 5.4 million shares. Over the previous 52-week period, its price has been fluctuating between $7.17 and $24.34. The market cap of EVGO is currently at $2.8 billion, compared to an enterprise value of $3.2 billion in its enterprise value. The difference between the market cap and the EV is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, asset composition, and I would say an element of speculation in it as well. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn may negatively impact its profitability and solvency. Another key element to understand is the asset composition of many companies, and it is especially true for growth-type companies. For many of those, one of the most significant assets they own is called goodwill. Goodwill is basically an expectation of the market that the market is able to generate more profit or to have more growth than another company, partially because it has a good management, stronger brand recognition, bigger following online, and so on. In other words, it's not a tangible asset that companies may use. However, it's often the reason why some companies, and in my opinion EVGO included, are perceived to be trading at a discount, because the market cap is lower than the enterprise value, which is the value that market gives to the assets over debts that are paid off. In comparison to its historical price fluctuations, the stock is 14.5% higher than its 1-month low, 33.2% higher than the 3-month low, and 41.6% higher than a 52-week low. In terms of the options market, which often gives a hint of the market sentiment on where the stock price is likely going to head toward, the implied volatility is 79.5% compared to a historical volatility of 74.7%. The put-call volume ratio is currently at 0.44, meaning there are still much more calls than put options. The most recent volume of options traded has been 6,500 contracts within a day, compared to a 30-day average of 8,400 a day. In terms of the open interest, the most recent volume of open interest has been 111,000 contracts, compared to the 30-day average of 115,000 contracts. In terms of its shareholder structure, institutional shareholders now hold about 42% of its outstanding shares. The biggest shareholders include Pictet Asset Management, Vanguard, and Invesco Wilderhill. The relevance of the shareholder structure is important here to determine whether you should be holding the stock long-term or view it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Of course, there are a lot of exceptions from what I said above, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment, and not just a short-term trade. Let's also look at the short interest present in the stock, which is the amount of positions that aim to profit if the share price falls lower. Sometimes, if there are significant short interest in the total volume, it could be a sign that there is an organized shorting operation going on, like what has been going on with GameStop, Ethereum, or AMC. The current short interest is 19.9% of the total float and 66% of the dark pool transactions. So in other words, yes, there seems to be a very significant and, in my opinion, organized short operation going on against EVGO. Now, let's also take a look at the indicators. Financial indicators do give us some suggestions of where the price movements seem to be going, and they can be used as one of the elements to determine what should be our overall approach. The oscillators are showing 1 sell, 8 neutral, and 2 buys. So overall, they're suggesting an overall tendency of being neutral. The moving averages of the past price action have 13 sell, 1 neutral, and 1 buy. The overall tendency from the perspective of moving averages is to strongly sell. The moving average can be used to determine whether the stock is overbought or oversold compared to its previous price fluctuations, which can be used to see if your trade is sufficiently well timed. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $5.95, $7.83, and $9.49. For the resistance levels, they are $10.39, $13.88, and $15.75. Looking at the EVGO from both a corporate and equity perspective, it is a decent company with lots of potentials, but like the rest of the market pretty much, it is subject to being influenced by speculation. Market participants, and more specifically retail traders, are attracted by the company because it is a company massively owned by institutional and retail traders alike, expecting it to not only do well, but to be able to last. And from where the statistics are showing, it seems to be able to last for a long time because it has good results. Market participants are attracted by the company because it is a company belonging to a very promising sector, since it's part of the peripherals of the electric vehicle sector and, more generally speaking, part of the larger energy sector revamp that is going on and probably going to go beyond, like way beyond the EV sector. Right now, the analysts influence greatly the price because despite the excellent results the company recently had, their opinions can affect the performance of the company's stock, which seems to be the only actual catalyst to justify the recent slump. My opinion on the company remains overall worthy of your time and that it deserves to remain on your watch list and eventually in your portfolio if you're future-oriented. With that being said, I would recommend to consider going in now, or at least part of your allocations now, and start buying them in small batches. In terms of its price action, the downward trend seems to have found some support for the time being, and a rebound is expected to happen sometime soon, even though regarding whether the trends have reversed, it's another story, since we still have to see whether the peaks of the previous highs can be surpassed this time. My recommendation is to make sure that your exposure in EVGO is at a maximum of 0.5 to 1% of your portfolio, and to buy in small batches as we go forward, with around 25% of the allocations now in the current price level. Regarding the profit target, the previous peaks are a good place to start looking. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy. and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.